Good evening, everyone. Time for another silver update. This is the daily chart of silver provided by netdania.com. You can click on the link below. I've drawn out a fairly long-term view. This goes back to the bottom of 2008. You can see that we've pretty much been on a steady rally since then with this outlier breakout and breakdown. But you can see the trend lines are still fanning upwards. And we've got the MACD. Both of these are forming gigantic pennant formations. This is seems to be a rising pennant, but it's just so large it's hard to even get a perspective on it. Does this portend a future explosion to the upside? I think it does. When will that come? I don't know. You can see if we take the most extreme blue lines and extend them out into the future, we've got a high of about $35, a low at about $25, and we're right in the middle of that. That would probably extend out maybe 8 months to 12 months before those two meet. So it's a very, very large formation, and it's just a big opportunity to do more stacking. So I'm not going to make any predictions except that in the long run, silver is going to catch up to at least its old high, and then I believe its inflation adjusted price, and then probably its shadow stat inflation adjusted price. So through 50, through 100, towards 300 or so is my guess, but I can't say when. Now let's go over to the question of the night. And this is from Slarty Bart Fast, I guess is how you pronounce that. It's called Government Cheese. Brother John, I listened to your latest YouTube and, well, you've got to be kidding. The budget deficit is not the fault of the politicians. Why do you rail on and on about how they don't have the guts to balance the budget? They would be torn to pieces if they tried to do the right thing. That's right, it's the population of the USA that drives their wild spending ways. Before you scoff, consider this. In 2010, fully 17.4% of the U.S. population was dependent upon federal transfer payments of their daily bread. Add to that nearly 10% of Americans that work directly for the government. We're at around 28%. Now add in all the people who work for government contractors and government-supported institutions like teachers, etc. Add it all up and you get this quote from U.S. News and World Report back in 2009. Quote, by one measure, the government already plays an outsized role in our so-called free market economy, and it has little to do with the recession. Economist Gary Shilling has calculated that 58% of the population is dependent on the government for major parts of their income, including teachers, soldiers, bureaucrats, and other government employees, welfare and Social Security recipients, government pensioners, public housing beneficiaries, and people who work for government contractors. By 2018, Shilling estimates an astounding 67% of Americans could be dependent on the government for their livelihood. The implications aren't comforting. Face it, man, we are the mob of Rome. Just like the late Roman emperors, the Republicrats, Demopublicans, know darn well that they have to keep the NFL games running and the government handouts flowing, or we will turn on them and tear them to pieces. My wife and I have a personal experience that supports this. She volunteered for the Ron Paul campaign and spent several nights pounding the phones for him. She found fully 75% of the people she called were violently opposed to Ron Paul. They were actually terrified of him. Why? Because they just knew he would take away their government cheese. They'd grown so dependent upon government cheese that they didn't think they could survive without it. The mob. Face it, when this system collapses, it's not so much the government that's going to collapse, it's 75% of your well-off neighbors that are going to lose their minds. They've never known anything but living on handouts and cushy, protected, do-nothing jobs their whole lives. We've met the enemy, and indeed, they are us. So, interesting comment. I actually agree with the bulk of it. I don't agree that this can't be turned around. I think that my proposal that if you cut government across the board by 50%, it would be a lot of short term pain, but this thing could be turned around. Do I think that's going to happen? Very unlikely. But also, this trend has been encouraged recently definitely by the politicians. So I hold the politicians accountable. Now, I've warned in the past that if you get your money from government cheese, basically, if it's a transfer payment from someone else, and that's essentially what government cheese is taking wealth from one person and giving it to another. I know people are going to say, well, we invested it. No, you didn't. They didn't. They were fiduciaries and they broke their fiduciary obligation, and they wasted the money. So that money's gone. So these are all transfer payments now. These are the young generation coming up having their money taken from them, and it's just not going to work out. So I think these people, as you see in a lot of the municipal bankruptcies that are trying to be avoided of late, I think Providence is one that comes to mind. The people in the union begin to negotiate because they see that the end game of bankruptcy is going to put their pensions into receivership, and they may get 50 cents on the dollar if they're lucky. They may get a lot less than that. So there comes a point where the people who are going to be getting this government cheese are going to realize that there's not enough people contributing and there's too many people taking, and the whole system is going to collapse. So either way, whether the Ron Paul types succeed and actually end up cutting this stuff, or whether the whole system collapses upon itself, either way, you are not well served by continuing to depend on government cheese, because one way or the other, it's going to be taken away when the collapse comes or when the cuts come. There's no alternative. It's either going to be austerity or it's going to be collapse. So my suggestion is that while you have time, you should be stockpiling silver and gold. You should be learning skills that will help you in the new economy. You should, if you can, make foreign connections with other investments with outside of the United States and outside of the Western corrupt governments. And if you can join Doug Casey or people like that, like-minded people who are opting out of the system, not contributing to a system that is corrupt and they just want out. A lot of people are leaving the country, renouncing their citizenship. There's a lot of things you can do to not participate, but I strongly suggest that you do not participate in this because it's going to be cut one or the other. So essentially we agree on that. Now the main topic of the night, this is a listener sent this to me, and this has been covered by a couple of the other blogs and other sites. I hadn't had a chance to examine this fully, and I just did a skim over it, and there's some really striking things. I want to show you one chart that is really striking here. So let's go ahead and do the full screen. This is called Desynchronized and Long-Lasting Structural Change on Commodity Markets, Evidence from High-Frequency Data. Now, if you remember, Bixweir, who has a lot of critics, I would say, a lot of critics, who claims there's a good guy faction and a bad guy faction operating in this thing. Bix has argued for years that the markets are essentially all fake and they're controlled by computers and the prices aren't real. This is just another way that Bix is looking to be more correct as we delve into this. Now, if you remember the May flash crash, that was a HFT, high frequency trading algorithm based collapse where you had a lot of stocks that actually went straight to zero through high frequency trading. These are computer trades. I think in the silver market recently, I think it was an ETF that someone counted 75,000 trades within a second. So these are incomprehensible. This is incomprehensible speed going on here. And obviously, if you have 75,000 trades in a second, then no one's actually making a decision. That's too fast. There's no way that a human being could make a decision of whether to go long or short based on that. So let's delve into the data a little bit here, and I want to take you to a table that is very telling, actually shocking. And that's this table here. Let's expand it a little bit. It doesn't look like I can do that. So this table is the number of trades recorded in the Thomson Reuters tick history database by instruments and year 1996 through 2011. Now, unfortunately, he didn't include gold and silver in here. I would like to see those, but these are telling enough. You can see back in 1996, now the S&P mini contract didn't exist, but you've got oil, corn, soybeans, sugar, wheat, and live cattle, and you're talking very, very low numbers. You can see for oil 300,000, then 100, basically 100,000 across the board. Jump down to the 2011. 41 million, 10 million, 7 million, 4 million, 5 million, 3 million. So you can see this growth. This is actually exponential growth. And just to give you an idea of how crazy this growth is, all you need to do is come down and look at the total here. Now this is 15 years of data. And if you look at the total on live cattle, you can see the total is not quite 9 million. 2011 and 2010 put together are over 6 million. So 60%, 70% of all the trading was in those 2 years. With wheat, you've got 8 million, you got half of the 15. With sugar, you got 8 million, you got nearly half. With soybeans, you got 12, more than 50% of the trading in the last 2 years. And corn, you've got 18 million out of 26. That's nearing 3/4. And 71 million for the oil. And then you've got about 1/3 for the S&P. So something really crazy is going on here. And my guess is, as a lot of people have pointed out, I think Charles Biederman pointed out recently, that the markets are rigged. We're actually looking at false markets for all of these things. They're being controlled by computers that are trading very rapidly so that no real trader can take a position without potentially getting blown out. Then you throw in the MF Global thing, and you're just looking at an impossible situation for a legitimate trader to be involved in these markets. So I highly encourage you. This is a very technical paper. If you're into that sort of thing, go ahead and examine it. I want to drop down to the conclusion that he draws here. He tries not to point a lot of fingers, so I'll go ahead and point them for him. His conclusion: this paper documented striking similarities in the evolution of the rolling correlations between the returns on several commodity futures and the ones on the U.S. stock market, computed at high frequencies. It also highlighted a structural change that took place recently in these markets. Prior to 2008, high-frequency co-movements between commodity and equity markets did not usually differ from zero over a long-lasting period at such high frequencies. In the course of 2008, these correlations departed from zero and became strongly positive after the collapse of Lehman Brothers. The persistence of this trend until December of 2011, except for crude oil in early 2011, which coincides with the uprising in Libya, remains difficult to explain. Further research is needed to get a complete understanding of the mechanisms at work behind the structural change. Let me give you a hint. It's rigged. Yet, given high frequencies, we think that HFT strategies, in particular the trend following ones, are playing a key role. We believe a conjunction of factors made that change possible. First, financial technical innovation spurred HFT through gradual introduction of fully electronic trading on exchange platforms since 2005. Second, investors moved away from passive strategies and opted for active ones when the rising trends on equity and commodity markets stopped, in particular since the fall of 2008. Third, lasting uncertainties and positive feedback effects reinforced this trend, and et cetera, et cetera, et cetera. So he's kind of being mealy mouthed here. Let me put it in simple terms. Wall Street is a rigged casino. It's always been a rigged casino, but it's much, much worse now, partly because they've abrogated the rule of law. Now they've taken that abrogation of the rule of law and applied it to the commodity markets with MF Global stealing customer money. And now we've got these algos that crashed the stock market in May of 2011. And they've now come into the commodities markets. So we've got this basically computer virus infecting all the markets. The government suppressing the prices of things that indicate there's inflation, and then Wall Street, of course, front running and stealing from their own customers. So that's the upshot of all that, and of course, that's just another reason why you have to continue stacking physical silver. There are two incredible reasons. The first, the question that I had about the government cheese, which is going to end. There's no question it's going to end one way or the other. It's going to collapse. The system will collapse. And the stock market itself, actually, if you follow the CAFR studies, which I've followed before, a huge percentage of stocks are owned by these government pension funds. So that's going to collapse. They're connected together, and when the whole thing comes crashing down, then you're going to want to sit with some kind of real asset that's going to include anything that has, as Ann Barnhart once said, that if you can stand in front of it with an assault rifle and defend it, then it's a good investment. And we'll talk to you next time.